So you've got $10,000 and you're finally ready to put it into the share market for the very first time. And the question running through your head is probably, which stock should I buy? It feels like the obvious question. It's the one everyone asks. But here's the uncomfortable truth. It's the wrong question. And if you get this part wrong right at the start, it can quietly cost you tens of thousands of dollars over your lifetime. So today, we're going to fix that. No hype, no hot tips, no get-rich-quick nonsense. Just a clear, honest walkthrough of how an everyday Australian can put their first $10,000 to work properly. Let's get into it. Let's start with why which stock is the wrong question. When you buy a single company's shares, you're really doing two things at once. You're betting that this one business does well, and you're betting that you know something about its future that the rest of the market hasn't already worked out. And that second bet is the hard one. There are thousands of professional fund managers out there. People with research teams, expensive data terminals, and decades of experience. And the evidence is brutally consistent. Most of them fail to beat the overall market over the long run. So if the professionals struggle to pick winners, the odds of a first-time investor doing it casually on a Sunday afternoon are, let's just say, not great. And there's a deeper problem. When you've only got $10,000 to your name, putting it all into one or two companies means a single bad result can wipe out a huge chunk of your money. One profit downgrade, one scandal, one industry that suddenly falls out of favor, and years of hard saving can evaporate. This is the trap. Concentrating your money in just a few stocks doesn't only lower your expected return, it cranks up your risk at the exact moment you can least afford to take it. So, if picking individual stocks is the wrong move, what's the right one? The answer is something that sounds almost too simple. Diversification. Spreading your money across hundreds or even thousands of companies all at once. There's a famous saying in investing that diversification is the only free lunch. It's the one thing that genuinely lowers your risk without lowering your expected return. And the everyday tool that makes this possible is the index fund, which you usually buy as an exchange-traded fund. You'll hear people call it an ETF. Here's the whole idea in one sentence. Instead of trying to find the single needle in the haystack, you simply buy the entire haystack. One broad index fund holds a tiny slice of every major company in a market. So when you buy a single unit, you instantly own a small piece of hundreds of businesses at the same time. And the fees are tiny, often just a fraction of 1% each year. For an Australian investor, the common building blocks are refreshingly simple. There's a fund that tracks the broad Australian market, the biggest companies listed on the ASX, and there's a fund that tracks the global market. So your money isn't locked entirely to one small economy on the bottom of the map. Some people hold both, and plenty of people just hold a single, globally diversified fund and get on with their lives. Now, I'm describing categories here, not telling you exactly which fund to buy. But this, low-cost, broadly diversified index funds, is what the evidence actually supports for most everyday investors. All right, let's get practical. Here is how you actually do this. Step 1. Before you invest a single dollar, sort out your foundations. Make sure you've got an emergency fund, a few months of living expenses sitting safely in cash that you do not touch, and clear any high-interest debt, like a credit card first. Because investing money you might need next year is exactly how people get forced to sell at the worst possible time. And here's something worth sitting with. If you're working in Australia, you are already a share market investor, whether you realize it or not. Your superannuation is mostly invested in shares right now. So this $10,000 isn't really your first step into the market. It's the extra layer you're choosing to build on top of what you already own. Step 2. Open a brokerage account. These days, there are plenty of Australian share trading platforms with low or even zero brokerage fees. You transfer your money in, and you're ready to buy. Step 3. Buy your diversified fund. And then, this is genuinely the hard part, you leave it alone. Because here's what almost nobody likes to admit. The single biggest threat to your returns isn't the market, it's you. The market will fall regularly and sometimes sharply, and the natural human instinct is to panic and sell when prices are dropping. But selling low after buying high is precisely how ordinary people turn a perfectly good investment into a bad one. Discipline beats brilliance. One last decision. Should you invest all $10,000 at once or spread it out over a few months? Investing it all in one go actually wins more often than not, historically speaking. But spreading it in, a method called dollar cost averaging, can be far easier to stomach, especially if a sudden drop right after you invest would keep you awake at night. Honestly, either is fine. The worst choice is doing nothing at all. Now, a couple of specifics that are worth knowing before you start. Australian shares and funds can pay something called franking credits. Without diving too far down the rabbit hole, it's a tax benefit attached to the dividends you receive, designed so that company profits aren't taxed twice over. It's a genuine perk of investing here at home. And then there's capital gains tax, the tax you pay on your profit when you eventually sell. Right now, if you hold an investment for more than 12 months, you currently get a 50% discount on that gain. But take careful note, this is changing. Under the 2026 federal budget, that 50% discount is being replaced for gains that build up after the 1st of July 2027. It moves instead to a system based on inflation indexation with a 30% minimum tax rate. Now, this is announced, but it is not yet law, so it's well worth keeping an eye on if you're investing for the long haul. Our first $10,000 in the share market was never about finding the one perfect stock. It's about getting the boring stuff right. Sort out your foundations. Buy a low-cost, diversified index fund. Keep your fees low. And then have the quiet discipline to do absolutely nothing while everyone around you is panicking. That's it. That is the strategy that has quietly built wealth for ordinary Australians for decades. Not the hot tip, not the lottery ticket stock, but time, diversification, and patience. If this cleared a few things up for you, you know what to do. And we'll see you in the next one.